Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at the Walt Disney Company and we're going to do a stock analysis on Disney. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas on potential stocks to buy or value drops to avoid, make sure to subscribe to my channel. If you do want me to take a look at a stock, make sure to leave it below in the comments section. Okay, so getting into Disney now, let's first look at some of these higher level metrics here. First of all, I always like taking a glance at the little Guru Focus value band here. It's saying that we could be potentially significantly undervalued, but we're going to have to see if that's correct. And then what are we looking at right now for the PE? Current PE, because the earnings are way down, is 67, and the forward PE, based on basically analyst estimates, is currently sitting at 17. And for dividend yield, well, as many of you know, they've already cut their dividend, so there's no more dividend anymore for Walt Disney there. So let's get into the financials here. So you can basically see the revenue trend line in the green here, and they have been steadily going up over time, over the last 10 years, averaging 6.1%. But you also have to remember, this is based off some basically large acquisitions they've done. They've acquired 21st Century Fox, which was kind of more of a merger back in 2019. They also bought Star Wars back in 2012, and there's been another little series of mergers along the way. So the thing is, when they get bigger and bigger and bigger, and they do these mergers with these other very large companies, they're really going to have trouble growing at that same pace in the future. So we go down. I like to first take a look at what they're sitting at return on invested capital versus the weighted average cost of capital. Basically, since their acquisition of 21st Century Fox, return on invested capital has been just completely terrible. And weighted average cost of capital has been pretty consistent, although it has been going up lately, partially because their share price has been dropping quite a bit. So we get to the revenue, and you can basically see over time the revenue has been going up, and from effectively when they acquired Star Wars, they started capitalizing more on that. That spurred some growth for them. Some people do feel they haven't been doing a very good job with the Star Wars franchise and a lot of their stuff in general. So that is kind of one of the concerns of Disney, although, with the assets they do have, the intellectual property, it should be fine in the long run, regardless of any short-term mishaps. And then basically from 2018 to 2019 is when they acquired 21st Century Fox, and that gave them this big boost in revenue. And then, as we know, in 2020 there was COVID, where all the parks shut down. So that's one thing I'm going to quickly jump into right now, is basically just show you where the parks are sitting at. You can see actually before, since 2015, the attendance for the parks had been plateaued. So this is probably where they're looking up getting back to again, and kind of might be the peak overall. But they aren't even quite back there yet. So there is still some reversion of getting their parks revenue back up to the previous peak. How long is that going to take? It's hard to say. Right now, it does look like at some point, maybe in the future, there's going to be a recession. There's that inverted yield curve, so we may not be seeing that reversion to this previous basically trend in attendance in their parks anytime soon, until maybe several years down the road. But let's jump back into the financials. So their gross margin has been all over the place, and this is kind of the thing, is when they do these different acquisitions, like for example when they do the big Star Wars acquisition and also then the 21st Century Fox there, it changes their margins and also kind of changes their accounting a little bit. You can see in the operating margin here from 2012, it wasn't the hugest change from before, but then kind of they did get into this nice little sweet spot where I think they were releasing a lot of the Star Wars content, and they were basically bumping up into the operating margins in the mid-low 20%. And then when they basically bought 21st Century Fox, or merged with them, because it actually did dilute them as well, the operating margin has come back down. So now that they're kind of a different company and a different mix, it is going to be very difficult for them to get back to potentially these old operating margins pre-2019. So that's one thing you have to keep in mind, that just because they were able to get gross margins of 45% before and operating margins of 25% before, because they're a different basically product mix now, because they have 21st merged with 21st Century Fox, it's going to be really hard for them to get back to those margins, and they may be looking at lower ones. Maybe 17, I don't even know if they're going to get back there, because there is also a lot of other headwinds, which I think it's a good time to jump to that. We can kind of look at the earnings presentation here and kind of get an idea of where the revenue comes from. So they kind of have their linear networks, their direct to consumer, which is the Disney Plus and the Hulu, and then their other, content and licensing, and then there's also the parks, of course. So taking out the parks, let's just look at this media and entertainment. So Many of you may know or may not know that they've been in a little dispute with Charter Communications. Charter Communications is a cable provider. I've done a stock analysis on them. I actually do own the stock as well. And they basically have decided to cut out Disney's ESPN and sports packages. So a lot of this is coming down, as you can see, basically in the kind of Q3 2022 to Q3 2023, there was actually a quite significant drop in these linear networks while the direct-to-consumer is going up. So in a way where they're trying to go this direct-to-consumer with this Hulu, this Disney Plus, and this ESN Plus, which all are losing money right now, it's kind of cannibalizing their linear networks. Because as they're coming out with this stuff at cheaper prices, direct to consumers, all the cable networks that are paying them these really high prices for their basically media in these same packages, they want better deals or they're not going to basically have these Disney properties as before. So that's kind of one thing that I think needs to really be set for their future growth going forward, is they are kind of cannibalizing these linear networks, and it may potentially get worse before it gets better, and the direct to consumer really isn't making that much money. And also, again, parks still way off the peak from before. So that's just a little background of what their different earning streams are and what the potential headwinds may be. But let's continue just on the financials here, because this is what my channel is about. So we'll look at their interest expense. And again, the interest expense has been going way up, unfortunately. At least they do have a little bit of interest income, but still net interest, basically income or expense, is sitting at $1.4 billion. And right now, with the last year of their operating income being only $7.4 billion, that's quite a lot of interest income they're paying. So this is largely from basically the acquisition they did of 21st Century Fox in 2019. Took them on a lot more debt. That is also why they stopped their share buybacks. They cut their dividend. They're trying to pay down the debt. That is headed the right direction, but they do need to get this debt more under control, because you can see, look at all these past years before, barely any interest expense at all. With the interest income, it was a negligible thing, but now they have substantially more debt than before, and they ever effectively did in the past. So we go down, and luckily for the most part, they have been net income positive all the years except 2020, and we all know why that is. But there was a big drop in the net income, and you can even see basically when they did this acquisition from 2019 of 21st Century Fox, even though there was a $10 billion jump in the revenue, their net income actually went down over $1 billion. So that's kind of a little bit of a problem. You do this big acquisition, sure, you got some good assets for the long term, but it's kind of hurt your short-term profitability, and for these years going forward has not benefited them that well at all. And we can basically see EPS overall was pretty good before, it's really dropped before, and a lot of this story with Disney is going to be what level are they going to actually be able to recover before, and there's a lot of variables about that, because it's this cannibalizing their cable with their Disney Plus, and Hulu and ESPN Plus. How quickly are those going to get profitable? Are they going to have to make concessions with these cable companies? A lot of this is up in the air, and how quickly are the parks going to basically get back to the revenue? They've also said they're going to be doing a lot of capex spending on the parks as well. But let's look at basically the share buybacks here. So if we look at, for example, from 2010 into effectively 2019, they were buying back shares at a nice pace, returning investor capital to shareholders and everything. But then when they did the merger, the basically share count has rocketed back up again, and effectively sitting for the last decade, their share count is almost flat, maybe a little down. And right now they aren't looking at buying back any more shares, since they're paying back a lot of debt, as we'll get to in the balance sheet right now. So we can see current, basically they got some cash and cash equivalents. Total current assets sitting pretty good at $30 billion, but what's that compared to the total current liabilities? $28 billion. So this is a positive current ratio. So overall, they're going to be able to afford all their bills. Disney's really not a stock you should be expecting that they're going to go bankrupt. This isn't really the concern about it, as I'll show in the financials. It's really just well, what are they going to get to? What type of profitability are they going to be able to get to in the future with kind of this new business they've created with their merger and, everything else changing on the landscape of media effectively. And then we can see total assets sitting at over $200 billion, but there is a lot of goodwill. Well, they do have $91 billion of total intangibles. Almost $78 billion of that is goodwill. And you can see when they did this acquisition of 21st Century Fox here, they went from $30 billion of goodwill to $80 billion of goodwill. So there's a lot of goodwill sitting on their balance sheet there. And that also is a concern. If they basically find that their acquisition of 21st Century Fox isn't paying off like it should have, because maybe all this, content they're supposed to be basically, selling to these, the linear networks and everything. They're cutting the subscriptions, not wanting to do it, and they have to write down this goodwill. You're going to have a lot of basically write-offs of goodwill, and there'll be lower earnings in the future, and the market will not like that. So that is a big risk right now with all that goodwill that basically they have acquired. So that is something you need to kind of keep on top of watching and see if they're going to be writing any of that down. But then basically their total liabilities, $92 billion. That leaves them basically total stockholder equity of $97 billion. But again, $77 billion of that is goodwill. So in reality, we maybe only have $20 billion of real tangible equity. Most of that is also in intangibles, although I do believe the intangibles they have of, the Disney brand, the Star Wars, Mickey Mouse, now the Simpsons and everything does have a lot of value to it. So I think even if they had to sell off some brands, these intangibles do actually have real tangible value. So they do have maybe about $20 billion of actual, total stockholder equity sitting on their balance sheet. So let's jump into the cash flow statement now. So I always like looking at kind of how they're depreciating against what they're basically repurchasing in plant, property, and equipment. And overall, you can kind of see here in the past, they used to purchase at a little bit higher rate of plant, property, and equipment, say between 2009 and let's see, going forward to about 2018, they were always purchasing more plant, property, and equipment, upgrading those parks and whatever else they have to do for the other parts of their business versus what they're depreciating. But in the last several years, they've been actually depreciating more than they've been purchasing. And this also gets into why they've been basically recently saying what they're going to be doing is they're going to be putting more money into basically CapEx to renovate those parks, because we have seen for the last several years now they have been skimping on it. A lot of this probably is due to the shutdowns because of COVID and everything, but it basically does mean there is going to be this extra cash flow they are going to have to start dedicating to that again. And you can also see they, other than the big purchases they do, for example, the Star Wars and the 21st Century Fox, they do other little acquisitions over time. So they are this media empire that, is acquiring a lot of good stuff effectively. And you can see repurchase of stock. They were pre-purchasing a lot before, but after this acquisition, that's gone away. And also cash flow from dividends. They were paying out nice dividends, and now those have gone away too. So, and the good thing is, though, is they basically have started net issuance of debt. They have more. They're paying down the debt right now because basically they're taking out very little debt in the last few years, and they're still trying to pay down some billions. So the nice thing is they effectively do have some still reasonable, like basically free cash flow going, which is good. And they're basically using that to pay down the debt. But with the cash flow where it is, it's going to be a very struggle for them to afford any acquisitions. Also, with all this debt they currently have and wanting to pay down, that's also going to be very difficult for them to do as well. So let's get into the interactive chart now and do a little bit of a relative analysis here. So as we're waiting for that to load up, let's pop up our revenue with estimate. Basically, compilation of the analyst estimates, the average, and let's do the EPS with estimate here as well. So as we can see, they are expecting the revenue to go around, a nice pace, but even though it's like, from here, they're expecting $4 or $5 billion in revenue growth, this is getting below 5% growth now. So there's going to be very slow growth going in the future. And they do think that there is going to be kind of a little bit of a quicker recovery for the EPS, but it's still quite a bit off the highs. And really, we're looking only 2 years of getting to maybe 577, which is equivalently what they were at 2016. So even if this, I don't know if this is an optimistic recovery scenario or not, it might not be this good because there's a lot changing, like I've said, in the whole like media landscape of their relationship with the cable providers and the relationship with direct-to-consumer. So if they aren't able to achieve these EPS going forward, that probably is going to be, even worse news for them going forward. But let's pop up their price to sales ratio here and get an idea for that. And I'm also going to pop up the debt margin because that's kind of price to sales is relative to your net margin. So I'll pop up the net margin on top of that. And you can see kind of how it was before, like back between 2002, even into 2012, they were a little bit lower on the net margin, effectively more around 10%. And then they had this little zone here when they had the Star Wars, but before 21st Century Fox, we were going 15, 16 plus. So during this period of time, again, we already looked before at the gross margin to operating margin, probably likely not going to get back to those levels. So we may be looking at lower levels like this to comp against. And then their net margins crushed. Right now, they're extremely low. So let's take off the net margin and see what our price to sales effectively looks like. Let's take off that. Take off the price. And you can see the price to sales ratio is getting lower. Again, I wouldn't be expecting it to return anytime soon. These levels where it was like a 3.5 price to sales, or even like, close to a 3. And these are kind of the more comparable bottoms during this period here. And there are potentially lower lows, such as 2008, 2009. If things got really bad, it got down to 0.65. Probably things aren't going to get that bad, but you always kind of have to, leave that open. And for a lot of these other times, they were sitting, just above 1. So there is still potential downside on the price to sales ratio, because if you compare net margins, this on the high side, there may be at a 2, 2.2, and 1.72 with only upside to 2.2, basically price to sales ratio is actually not a lot of upside. Let's also just take a quick look at the PE ratio, just to kind of see when some years when they were profitable, of effectively what the PE was trading at. So I want to try to get out of a little bit of that older time there. Kind of hard to obviously see it because of this, but you can see here, basically they were trading before 2008 around the 20 PE. Then when basically the great financial crisis was starting, they were dropping to a 15, into a 14, a 13, and the lowest they were actually below a 10 PE ratio. So just think that it wouldn't be completely unexpected if Disney got below a 10 PE ratio if a lot of these current headwinds continue being headwinds and don't recover quickly. Just to get an idea of what's possible. So on the high side here, they're getting back up to a 20, low teens, mid teens. That's typically where they've traded. So like Disney's a company that, from those historical perspectives, they've kind of traded at this high side of a 20 PE, and the low side is kind of in the mid to low teens. And if things go really bad, it could be even lower. So I'm just gonna go price with PE with EPS estimate. So it's also an interesting way, because this is going to apply a P ratio to the analyst estimates right now. So as you can see, this isn't very good, because they're saying based on, that's a 15 PE. Effectively, they're saying in 2 years at a 15 PE with the analyst estimates basically during 2024, we'd be looking at maybe a $54 stock price. So, just get an idea of a 15 PE, that this actually could justify a lot lower prices for Disney. And now if we get into the chart here, that's also kind of what I'm seeing in the chart. Effectively, I have my big pitchfork channel here, and from a technicals perspective, this is a really bad look for a stock. Like this is a big top, and once effectively you start losing the supports here, I believe it's a very high likely they can basically trade down into the 40s, because that's where this big support is here. Valuation wise, that would also make sense if basically the parks are still having headwinds because of a bad economy and recovering. They're also basically, as I said before, losing their linear networks and cannibalizing it to the direct to consumer, lowering their earnings, and earnings in the future only being what they are expected. It wouldn't be a surprise to actually see us drop into a lower price. Maybe it's the 60s, maybe it's the 50s, maybe even as low as 40. So either way, right now for Disney, this is a stock I would like to own in the future. I'm waiting for it to come down a lot more, or at least start basing. Who knows? Like, I always look at kind of how low things could possibly get, but things always don't have to get that low. But right now, when I see the risk reward of where things are for Disney, I don't see a whole lot of upside or worth it. I would want to probably start buying, at least let it get into the 60s or something, or just let it play out, eventually base a little bit, make a bottom, and if it gets really low, that's when I'm going to jump in and buy it at least. But I hope you like my insights in the stock analysis. Make sure to subscribe to my channel, like the video, and I will see you in the next stock analysis.